Hey everybody, Rob Maurer here, and today I want to spend most of our time talking about the price cuts for Tesla vehicles that have happened over the last day. I am recording during market hours, but despite these price decreases, Tesla stock has performed okay. Right now, as I'm recording, it's only down 1.3%, with the Nasdaq down about 0.7%, and the directionality has mostly followed the Nasdaq for the day so far. To catch people up on the price changes, if you haven't seen it yet, the biggest price changes are in North America. Tesla has reduced the price of all Model S and X vehicles by $5,000. And they've reduced the price of all Model 3 vehicles by $2,000 in the United States. And then for Model S and Model X, previously those came with free unlimited supercharging. That is no longer included. In China, Tesla has held the price of the made in China Model 3s, but they have reportedly reduced the price of the import Model S and Model X by about 4%. And then for Europe, there have been some price changes in some individual countries, but for the most part, Europe seems to be unimpacted. Alright, so the reason that I say it's a bit surprising that the stock isn't down a little bit more today is because generally when we see these price cuts from Tesla, the immediate reaction is, okay, Tesla has a demand issue, they're cutting prices to stoke demand because of that issue. That question in this case is exacerbated because we know for a month and a half Tesla's production has been shut down in Fremont, and of course the macro environment is kind of a mess right now. So if Tesla is production constrained, and they haven't been producing and they're still production constrained, why would they lower prices? And with the macro environment being poor, it makes sense for them to drop the price if demand is low. Those are good questions to ask, and I think the logic there makes sense, but I do think there's some nuance here that is worth discussing. The first idea that I want to introduce is that demand is not a singular concept. There are regional variations, there are seasonal variations, and then there are quarterly deadlines that unfortunately need to be managed around. These are all important factors to consider when we think about this price reduction. Let's take a look at the regionality and consider that with the context of the quarterly structure, and in particular how that impacts Tesla this Q2. Historically, how Tesla has scheduled their production at Fremont has been to use the first months of the quarter to build international vehicles, then they put them on a ship, and ship them over to Europe or to China, and as long as they build them and ship them early in the quarter, they can still be delivered within that same quarter. When we look at Q2, Tesla has been shut down for a month and a half, when they normally would be building those vehicles to ship internationally. So these first couple of weeks back, they can maybe get some production out over to Europe and get it delivered, but the vast majority of production from Fremont for Q2 is going to have to be delivered in North America if they want to deliver it in the same quarter it's produced in, which obviously based on how Tesla has operated in the past with the quarterly batching, they want to deliver it the same quarter. So bringing this back to the price cuts, we've seen price cuts now in North America, but not really in Europe, and not on the Model 3 especially in Europe. So while overall Tesla may have production constraints when we consider their entire vehicle lineup and all regions worldwide, there may be pockets of those production constraints. They may not have all the demand that they need in some markets for this particular quarter for some vehicles. These price cuts and the looming $1,000 price increase to full self-driving as an option can help stoke demand where it's needed for this quarter. This concept shouldn't be too surprising. We talked about this idea when we went through the Q2 and full year production and delivery forecasts. And overall, this is the direction we need to be expecting from Tesla. As they reduce costs, they're very likely to reduce price. So overall, when Tesla cuts prices, it should never really be a surprise. It's just a matter of timing and what that timing might implicate. Do I love this timing, knowing the production constraints that Tesla has come off of recently? No, I don't. But I'm also not sitting here panicking to adjust my forecasts either. The other idea that I want to bring into this topic is Tesla's margin control in general. Now that Gigafactory Shanghai is ramping up and the margins are strong there, and Model Y is ramping up, obviously with strong margins as well. With today's price cuts, we notably did not see any price reduction for the Model Y, and we did not see a price reduction for Gigafactory Shanghai, though obviously we had seen those a couple weeks ago. But here's the thing, as those margins improve on those newer products, Tesla is going to capture the higher margins there and use that to fund lower prices, thus lower margins in those older businesses like Fremont Model 3, Model S, and Model X. Tesla could just be stagnant and say, okay, we're going to sell all our vehicles at a 25% gross margin. Or what they can do is they can say, okay, we're production constrained at Shanghai, we're production constrained on Model Y. Let's capture a 30 or 35% margin on those vehicles, and let's use that extra margin to sell some of these other vehicles at, 15% or 18%. And that'll allow Tesla to continue to drive volume on those products and still mix out at a healthy total gross margin. We've talked a ton about how volume drives economies of scale that benefits the gross margin for the total company for all product lines through cheaper cost of goods sold in terms of the cost of materials. You have cheaper depreciation expenses as your factory does more units of production per time, etc. And then you also have the underappreciated or underdiscussed element of operating leverage, which reaps the same benefits from scale as your gross margins do. I mean, think about the Model 3, for example. It was able to leverage all of the infrastructure that had ever been built out for Model S and for Model X. You have the stores, you have service, you have the supercharger network. All those things had to be in place for Model S and Model X, but the Model 3 then comes along and leverages all that infrastructure. And hey, now the Model Y comes along and it gets to leverage all the infrastructure for not only the Model S and the Model X, but also the Model 3. And then we have Gigafactory Shanghai coming in with the Made in China Model 3, leveraging all that infrastructure as well. My point here as it relates to the price reductions today is that the same concepts that we discussed for gross margin also apply on the operating margin lines. So as Model Y and Gigafactory Shanghai ramp up, and that improves gross margins for the total company, it also improves operating margins, so Tesla has even more room to lower prices on those other vehicles and drive volume. So my overall takeaway is yes, I do think demand is a factor in this decision, but that doesn't necessarily mean that overall as a company, Tesla is not still production constrained. There are different pockets, and each need to be analyzed and adjusted accordingly, and that is what Tesla is doing here, in my opinion. So that's it for today, short and sweet. I want to make sure to give myself and everybody else time to follow the SpaceX stuff that's going on today, and best of luck to everybody involved in that mission. So thanks for listening. Don't forget to subscribe and sign up for notifications, and I'll see you tomorrow for the Thursday, May 28th episode of Tesla Daily. Thank you.